Welcome to the Treasury Update Podcast, Coffee Break Sessions, presented by Strategic Treasurer, covering foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jason Campbell, Business Development Leader at Strategic Treasurer. All right, welcome back to another great episode of Coffee Break Sessions. Today, chatting with me is going to be Paul Galloway, Senior Advisor at Strategic Treasurer. And Paul, before we get into this, this topic here is around revolvers. So I just want to make sure that everybody's clear. This is revolvers around debt and capital itself, and then the continuing of our conversations. Not necessarily your grandfather's revolver sitting somewhere in some closet, locked up safely somewhere. So Paul, how's it going today? How are you?
Doing good. Thanks for having me back again.
Yeah, good. It's always good, again, to chat with you. I mean, I always find it's just the way that you articulate around these interesting concepts as it relates to Treasury and finance as a whole is quite intriguing. So I'm looking forward to another great episode and kicking into turning it over to you to kind of walk us through this topic of revolvers. So what are revolvers?
Typically what happens with companies is they try to look at their balance sheet in totality. At the point that they're doing that, they're also taking into consideration strategic initiatives and what's going on with the organization, where it's going, what its financial position looks like, both from a cash flow and balance sheet perspective. Yeah, and so what they're doing is they're planning the total capital structure. And a component of that is this revolver component. And so you think about what are risks to my organization or my balance sheet in particular. In this case, we're talking about balance sheet. What are the balance sheet risks? And so they're trying to determine, do I have enough capital for everything I want to do if these certain particular events were to happen? And these events that they're considering are negative events. It could be tied to something that's going on in the industry. It could be economic. We're seeing all kinds of economic constraints or strains right now as we're trying to battle inflation. And as a whole, we're going to feel more pain out there in the markets. So it's going to be tougher to raise capital. Why? Because the Fed's raising rates, and it's going to squeeze the amount of cash that's available out there to engage in business activities. So it's trying to slow things down. What a revolver does is it's there in case the organization needs it because something unexpected happened, meaning there was a disruption, the market's dried up, and you need access to capital on a very short-term basis for something very specific. And typically, revolvers just sit on the balance sheet, and an organization will just pay that unutilized fee. It's a fee that's charged for not using the facility. They will only use that revolver for very specific things that are unexpected when capital is not available to draw upon, because you have capital committed other places and you need to fund something temporarily until you're able to access capital elsewhere. So that's typically why a revolver exists. And so the revolver itself is you go to a group of banks. It's typically relationships that you have established today. And these banks are strategic partners for you because, you use them for, let's take an insurance company because that's kind of a broad-based brush for a good example. So an insurance company will utilize, their banking partners for their operating banking needs. So, they provide lockbox, they provide DDAs for concentration and collection and disbursements. And then you got banks that they utilize for custodial service, trust services, trading services, meaning they execute trades with these banks. And so there's like a broader relationship. And as part of that relationship, these banks are willing to commit a certain level of capital in the form of a revolver to the company. It may be that they say, hey, we want to have $300 million revolver. Here's, the kinds of things that this revolver could be used for. And, we don't anticipate that we're going to draw upon it, but given these sets of things that may or may not occur, we could draw upon it for those occasions. And so the bank is literally committing funds off of its balance sheet to the organization. And so let's say it's anywhere from $25 to $50 million per bank, and you have a group of banks that could be, 6 to 10 banks to get to your $200-300 million that you want to have as a revolver. And so it sits on the balance sheet. And we talked about in the prior episode this idea or concept of contingent capital. A revolver is kind of like a contingent capital. It sits on the balance sheet. It's undrawn until it's needed.
Almost like a slush fund, right? But except it's sitting there waiting for it to be tapped into. So and another follow-up question to that piece of it is, I know that you said that an organization will go to these banks and say, hey, here's what we would typically, or would, if we tapped into it, this is what we would use it for, kind of ahead of time as that contingency, as you will, right? My question with that is, how do the banks benefit from this, right? So has the lender, what's the advantage of them of having a revolver set up with an organization?
That's a great question. And so typically, if you were to go to a banker and talk to them about, why would you do this for an organization? They're going to say, well, it's all based on relationship. It's all about the relationship. That's why they do it. Because typically a bank will view a revolver as a loss leader, meaning that they really don't make anything on it. Now, do they get paid fees? Yeah, they do. They do. They get paid this unutilized fee, but they've taken a portion of their balance sheet and they've committed it to that organization. So they can't deploy that capital to other things within the bank. So if the bank wanted to use a certain amount of capital to develop new products or do acquisitions or whatever, acquire things, they will have to fund that otherwise with something else if it's not on the balance sheet and accessible. So what happens is they set that to the side and say, nope, that's committed to XYZ company. XYZ company gets this. That's all I have to have is sitting there in case I ever draw upon it. They lose the opportunity to invest that capital in something else that would generate a higher return for them. And so that's why they view it as a loss leader. But what they realize is that the relationship with that company is really important, because in the example of the insurance company, they've got all these operating accounts. Perhaps they have trust and custodial services. They do trading. They engage in these activities across a broader banking platform. And all of that adds up and matters. And so the relationship is what's really important to them.
So are there any specifics for an organization? So if they just go talk to the bank that they have this relationship set up with, what's that setup process? If you don't mind, just quick second on just kind of explaining, what does that setup process look like?
Yeah, so you can think of our prior podcast, we talked about the issuance of debt or debt funding and what a bank will do or what a company do with a consortium or group of banks. This can be really similar for a revolver, except it's done on a private basis, meaning there aren't investors that are, making an investment in a bond that's issued. The banks are making the investment. They're making the investment based on the relationship and the broader scope of fees that they receive from the organization in totality. So what the company does is it goes to its key relationships and says, look, we're looking to, renew, or it could be that they're renewing a revolver or they're going to put a revolver in place. But let's say the company doesn't have one. So they're going to go with their relationships and they're going to go probably to their first or second strongest relationship to have a conversation. And they may select one as a lead. There could be a co-lead associated with it, meaning that those relationships or those banks are willing to put up more of their balance sheet towards the revolver facility. So they'll have a bigger commitment than some of the other banks might have. But some of the other banks are going to want to participate because of the relationship. And so they go through this process of finding out, okay, who wants to participate at a lead level? How much do they want to commit? Who wants to participate? And then they bring the group together. And they can do this through a couple of things. You can do that privately, like I've been talking about. It's the bank's balance sheet. And so that commitment, typically they call it a sidecar. And so you do this all privately negotiated transaction. The flip side is they could treat it somewhat like, you're going to go out and syndicate it. Typically, that's not the case with revolvers, but typically it's a private conversation with the banks, a group of banks. They all commit a certain level of capital to it. You draw up the legal documents and agree to the terms. And, you got to have favorable terms on both sides between the banks who are trying to mitigate their risks associated with committing their balance sheet to that organization. The organization, at the same token, is looking to minimize the amount of costs associated with it and get favorable terms that would be from a covenant perspective, which, covenants require an organization to do or not do certain things based on the terms that are written in the agreement. So it's kind of some back and forth negotiated terms to come together. And typically what happens is the lead bank or lead two banks, let's just say it's two banks. If it's more than one, you have co-lead, could be three maybe, depending on the size or the relationships. But you negotiate with those banks. They take that back out to the other banks and say, hey, here's the terms that have been negotiated. It just goes through this review process in several iterations until you commit to it. Then once you commit to it, you sign the documents, you got the backing, and you're off and running.
So real quickly, and it could be kind of a short response if you'd like, but are there any limitations to revolvers?
There is, and the limitation is based on what the banks are willing to commit. They're going to go through their due diligence, just like we talked about with the debt funding. They're going to want to talk to your senior management team, typically like the CEO and the CFO. They're going to ask questions. They're going to have an opportunity to ask questions. They're going to request information. They're going to do analysis. This is what the banks do. They got to do their credit checks, right? It's just like any other type of funding vehicle. The difference is that it's coming from the bank's balance sheet. So there's a limitation how much they're going to be willing to commit based on the relationship and their overall balance sheet structure that the bank has in place.
Well, I tell you, revolvers as a contingency option to tap into some capital for companies, it seems like a concept that I guess from a standpoint of, if you're looking at where you're going to get the extra capital that you need to fund different projects, seems like an interesting concept to explore. So thank you for joining me today, Paul. I really do appreciate it. And for our listeners, please ensure to tune in every first and third Thursday of the month for a new episode of the Coffee Break Session. As usual, if you have any questions, comments, or feedback, please send us a note at podcast@strategictreasure.com. Until next time, take care.
This podcast is provided for informational purposes only, and statements made by Strategic Treasure LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.